All right, let's talk about investing. Today, we're going to crack open the investor's playbook. We're going to look past all the noise about picking the next big stock and really get down to the core strategies, the equity strategies that drive pretty much every investment decision out there. Let's dive in.
It really all boils down to this one simple question. And don't let how simple it sounds fool you, because your answer to this question, it basically defines your entire investment journey. This is the fundamental choice, the real fork in the road. Are you trying to beat the market, or are you happy to be the market?
So that single choice, to beat the market or to be the market, it sends you down one of two very, very different paths. And each path has its own set of rules, its own tools, and honestly, its own way of keeping score. Let's break them down.
Okay, this slide just lays out the central conflict perfectly. Over here on one side, you've got passive management. Here, the goal isn't to be some kind of hero. It's just to mimic an index, like the S&P 500. The core belief is that markets are efficient, which is just a fancy way of saying all the known info is already baked into a stock's price. So you just track it. But then on the other side, you've got active management. The goal here is totally different. You want to outperform the market because you believe you can find an edge. You can forecast, you can time your trades, and you can win.
So let's explore that first playbook, the passive approach. This is that disciplined strategy of being the market. It's really for the investor who thinks trying to outsmart millions of other people all at once is, well, probably a fool's errand. The main idea behind passive management, or indexation, is really simple. You just replicate something. Take an S&P 500 tracker fund. Its one and only job is to own those 500 stocks in the exact same proportions as the index. So if the market goes up 10%, your fund goes up 10%. If it drops, well, you drop right along with it. You're not making bets on the market, you are the market. So why would you pick this path? The arguments are actually really powerful. For one, if you look at the data, very, very few active managers consistently beat the market over the long run. And because you're not paying some huge team of analysts, the fees are drastically lower, which makes a huge difference over time. Now, the major downside? A passive fund offers zero protection in a crash. By its very design, it just goes down with the ship. Now, let's look at the other side of the coin, the active playbook. This is for the investor who doesn't see the market as some perfectly efficient machine. They see it as an arena full of opportunities, mispriced assets, and overlooked potential. This is the world of hunting for an edge. And inside this active management world, there are two main game plans. You can either start from the 30,000-foot view, looking at the whole global economy and working your way down, that's the top-down approach, or you can start on the ground floor, digging into individual companies first and building your portfolio up from there. That's the bottom-up strategy. Taking a top-down approach is basically a three-step process. First, you start with the really big picture. Is the European economy looking stronger than the US right now? Then you zoom in to find the best sectors in that region. Maybe European banks are looking really promising. And only after you've made those big calls do you finally get around to picking individual bank stocks. It's all about getting that macro view right first. Now, a key tool for this sector selection step is something called the investment clock. And don't worry about reading everything on the screen here. The core idea is pretty simple. It suggests that as the economy moves through its four phases, from recession to recovery to boom, different types of companies tend to do well. For example, when the economy is hitting rock bottom and interest rates are low, sectors like construction and banking often lead the charge back. It's basically a framework for timing your bets based on the economic weather. The bottom-up approach, though, it completely flips that logic on its head. These managers, they pretty much ignore the economic cycle or which sector is hot right now. They are pure stock pickers. They're out there hunting for a great business with a unique product or some brilliant leadership that the rest of the market has totally overlooked. For them, a great company is a great investment, period.
But wait, it gets even more granular. Within that world of active management, and especially the bottom-up approach, managers adopt these really distinct styles. You can think of these as different playbooks for finding those winning stocks.
First up, we've got the original investment style, value investing. This is the art of bargain hunting. A value investor is trying to find a dollar's worth of a business that they can buy for, say, 50 cents. So the value playbook is all about finding companies whose real, true worth just isn't reflected in their current stock price. These are often solid, well-established, maybe even kind of boring businesses that pay out good dividends. The absolute key concept here is the margin of safety, which just means buying at such a low price that you have a built-in cushion just in case your analysis is a little bit off. Next up, we've got the polar opposite of the value hunter, the growth seeker. These investors are not looking for a bargain, they are looking for a rocket ship, and they are more than willing to pay a premium price today for a company they believe is going to dominate the world tomorrow. The growth playbook is all about spawning companies with a massive competitive advantage. We're talking unique tech, a powerful brand, something that lets them deliver explosive earnings growth. The risk? Well, these stocks are often priced for perfection, so if they fail to meet those sky-high expectations, the fall can be absolutely brutal. And finally, we have momentum investing, or what you might call the trend rider approach. The philosophy here is beautifully simple. Winners just keep on winning. See, a momentum investor isn't really interested in a company's deep intrinsic value or its long-term forecasts. They focus on just one thing, that stock's price chart. The strategy is to buy what's already hot and just ride that upward trend. It's all about jumping on the bandwagon and then knowing exactly when to jump off. So, we've laid out this great divide, right? Active versus passive. Beat the market versus be the market. But what if you don't have to choose? What if there's a way to actually get the best of both worlds? And this is such a key insight. You don't have to be a purist about it. In fact, some of the most effective modern strategies don't see active and passive as these opposing forces at all. They see them as complementary tools in a single, really powerful portfolio. It's called the core satellite approach, and honestly, it's pretty clever. The core of your portfolio, say 70 or 80% of it, is invested in those super low-cost passive index funds. This is your stable foundation. Then you use the smaller satellite portion to make some targeted active bets on things you truly believe in, like a high-growth tech fund or an emerging market. You get the stability of passive with the exciting potential upside of active. So there you have it, the entire investor's playbook. From that fundamental choice between active and passive, all the way to the specific strategies of value, growth, and momentum. We've even seen how you can combine them. Now the only question left is the same one we started with, but this time you've got the framework to answer it. What kind of investor will you be?